We are about to get started here. Welcome to our Q3 webinar. We are going to be covering 5 strategies to maximize your Roth IRA. So this is really a topic that affects a lot of us. Most of our adult lives or working lives, even if you're a minor, you've been told to set up a Roth IRA or start funding a Roth IRA. Those are various things that I think are important as we prepare for retirement and are considering how to best set up our future for tax-free growth. A Roth IRA is a great way to go ahead and begin that tax-free compounding that really is a integral part of your retirement planning, as well as distribution planning when it comes to income for retirement as well. So many people aren't aware of the different things you can actually use your Roth IRA for even before retirement. And so we're going to cover a lot of those things. A couple housekeeping items. We are recording this, so we will have the recording out. That will go out here later on this week. Also, too, we will be posting it to our website and YouTube, so you'll be able to go and pull this up later on as soon as we get that recording up there. So we'll go ahead and jump right in. If you have any questions, please feel free to use the Q&A window at the bottom, and we will get to those as soon as we finish up. So just a disclosure when it comes to providing this content, this information. This is for educational purposes only. It should not be relied upon as your only source of investment advice or legal advice. Please consult your attorney or CPA for any type of legal or tax advice. All right, so we decided to go ahead and model the Roth IRA as this superhero when it comes to retirement. There are so many different things you can do with it. Again, that tax-free growth being one of those main characteristics of a Roth IRA, but if you understand the other potential opportunities that Roth IRAs offer, so if we do and take advantage of those other opportunities properly, Roth IRAs can really provide access to some funds before retirement age, providing for some tax-free withdrawal options, acting as a kind of a secondary source of emergency funds without having those excess taxes, penalties, interest, things like that can really negate any of those retirement savings or those long-term growth goals that you have for that account. Lastly, we're going to touch on why they're such a great tool as well for gifting and legacy planning for your heirs. So anyone who you want to give that best after death gift for, or even during life, that can be a great way to also set up really your heirs and your loved ones for the best possible inheritance and gifting that you can. So let's dive into why we see them as such a superhero when it comes to retirement planning. So the first thing when it comes to maximizing your Roth IRA, we're going to start out small. It's just to maximize those annual contributions. So think of this as really the freebie when it comes to investing for retirement. So there's only a certain number of things that IRS allows us to really take advantage of and invest for retirement in, and this is one of those. So currently, as it stands, you can you can deposit up to $7,000 if you are under 50 and $8,000 if you're over 50 per year. So that's just an annual contribution. Again, that small slice of the pie that IRS allows you to go ahead and take advantage of. So if you're still working, if you have cash in the bank, any of those funds that you've already paid tax on and that you're planning on using for that long-term growth, really should be kind of redirected or diverted into a Roth IRA if you have that just sitting on the sidelines, but it's not really to be used for anything except for retirement. That's going to get that into that tax-free growth vehicle and allow you to really go ahead and amp up those retirement savings. As far as the time that you can go ahead and start doing that, as soon as you get earned income, that's the best time, and that's the first time that you can start to go ahead and invest into that Roth IRA. So, even minors, I talked about, if you know of anyone, if you are a parent, grandparent, aunt, uncle, that someone that is young is earning income. You can deposit up to that maximum that they are earning into a Roth IRA, even if they're under 18. So Roth IRAs can be started, well before someone reaches age 18 if you're earning that earned income. One of the nice things about any type of Roth IRAs, regular IRAs, as well, is they're just very easy. With the advent of technology and all the different brokerage firms and all the different ways to invest these days, you can just very easily set one up all online. You can automate those contributions, and then you can set up, those recurring contributions to really just maintain that retirement saving, that retirement momentum. If you want to divide up that annual contribution amount into 12 equal chunks, you can do that. You can set up a biweekly deposit, really anything to really customize those automatic deposits and those investments. One great option as well. The IRS does allow you to go ahead and deposit for two different spouses if you're married. So if you file a joint tax return, your whole household income does qualify towards those those IRS earned income requirements. And so if you are working, your spouse is working, but a non-working spouse is also part of the household, that's okay. You can still go ahead and you can set up a Roth IRA for your spouse, even if they're not working. We'll go over income limits here later on in the presentation, but as long as you're not over those income limits, you can still go ahead and use a Roth IRA for both spouses. All right, we'll touch on the next one here. That's going to be our conversion conversation. So conversions are a great way to go ahead and get money out of a traditional IRA or 401k. That are the more common types of ways to invest, whether it's through an employer or you're self-employed, that allows you to get that money into a tax-free vehicle such as a Roth IRA. So there's a couple different ways to go about this. The first one is going to be just converting money over from a traditional to a Roth. So pretty straightforward. What this does is just kind of takes that tax status, moves it from a pre-tax vehicle, which is that traditional IRA, and then we go ahead and we pay the tax whenever we convert that, and then just move that over to that Roth IRA. And again, what that does, that kind of locks in that tax as soon as you do that conversion, but you then get that into that tax-free vehicle that allows you to go ahead and start investing that and getting that tax-free growth. So, again, people would ask, hey, why should I do this? Why would I want to go ahead and pay those taxes? I can defer those till retirement, when my income is supposedly lower, is generally the thought process. However, if you are in a low income year, you can go ahead and you can add income that allows you to go ahead and pay maybe that same marginal rate that you're in. Right now, we do have a pretty manageable rate at the 12% threshold under current tax law. That is a very, very appealing rate to go ahead and pay those taxes at. So we'll go into a visual here in just a minute, but really filling up those very low tax brackets is a great strategy because you can go ahead and you can pay those taxes now instead of when you have to. So if you are a parent or even a grandparent or someone who's traveled with kids, you know how the bathroom breaks go when it comes to stopping on the side of the road when you're on a trip. And so instead of going to the bathroom when you can, we like to go ahead and say convert when you can, not when you have to. So being proactive on that and actually going ahead and paying a small rate of tax now is better than having to go ahead and pay a large amount of tax later. So the goal on that, as it says on the last bullet point here, is to go ahead and just kind of smooth out those taxes. So when we are actually looking at clients' returns and we're looking at their tax rate over the last 2, 3, 4, 5 years, anytime we see a 0% tax rate or a zero tax that someone is paying, that's actually not a good thing because there's always ways that we can go ahead and we can maximize your tax rate without giving you a lot of taxes. But the chances are that if you pay zero tax in one year, you're going to actually pay a lot more in another year because of that. So we'll go ahead and go into an example here that shows this here in just a minute. So one common conversion is to do these conversions during gap years. So gap years are common to see in pre-retirees or retirees, really between the age of about 55 to about 65, we see that gap years happen. So what is a gap year? That's basically when we are retired from our active jobs, our active income, but we're not quite yet on Social Security or maybe allowing a pension to grow a little bit longer before we withdraw those funds. and also not on Medicare yet as well. So there's a time when we're maybe not earning a lot of income, but we still have assets to draw from. So it's usually important whenever we are looking at conversions during these gap years to have another source of funds to pull from for income. Um, Let me go ahead and I'm going to just actually go to the next slide real quick and we'll come back to this one because I think it'll help us to visualize this a little bit more here. So really, if I can draw your attention to the two green buckets that are on this slide with the red arrows, those are really what the gap years are looking like when it comes to a graph of our income. So you can see there where the blue line, the blue fill is really that the income amount that we make per year. And so you can see that gradually goes up with inflation. We know that taxable income rates go up as income goes up as well. And then that green fill is really where we're adding income on purpose. So that's the key point, is that we're not just letting that tax rate drop down to the 10% bracket, but we are purposely filling up that next green line, which is where the 12% bracket stops. So that again, that green line is where we see that 12% bracket really cap out. So instead of paying 0% on maybe a little bit of income, we're going to go ahead and we're going to say, okay, I'm willing to pay that 12% rate. That's the second lowest marginal rate under our current tax code, in exchange for that amount that I'm converting to be eligible to be withdrawn down the road at a 0% rate or tax-free rate, if I'm following all the right rules. And so we are purposely adding that income in to be able to do that during those gap years. So you can see here where there is a drop actually at age 73. And so that is typically when you're going to see maybe other types of income come into play, or maybe a spouse stops working if there's going to be maybe the spouses are different ages. So there's various reasons why this one isn't necessarily just at 55 to 65, but typically you're going to see a couple different times where you can't add that income. So let me go back to that previous slide real quick just to cover a couple other points. As I mentioned, it's usually important to have another source of funds to draw from for income during those low income years. That way, you're not reporting income to the IRS. And so, again, that can be maybe a taxable brokerage account that's not an IRA. That can be also maybe just cash in the bank that you've saved up. One thing that we do to help folks prepare for retirement here is that we typically want them to be diversified from a tax standpoint. And what that means is usually having a combination of non-IRA, IRA, and then Roth IRA assets. And so during this year, we typically would advise someone to go ahead and pull from those non-IRA assets. That way we can have the most room possible to make those Roth conversions. A couple other items to mention when it comes to the Roth IRAs that are kind of side benefits is that required minimum distributions are not required for Roth IRAs. And so one thing that we always are mindful of when it comes to retirees and income planning, right now under current rule, if you were to turn age 73, that is the year that you're required to go ahead and take out a certain percentage of your traditional IRA for income. And so it starts out a little bit smaller and then kind of grows from there. That's just an IRS rule. However, if you are moving those monies into a Roth IRA before that, you're actually lowering that IRA balance, meaning that you're going to have a smaller required minimum distribution as you convert that money before age 73. And also the other combination with that is that once you get that into that Roth IRA, you're now no longer required to take that required minimum distribution from that Roth IRA because you've already paid the tax when you do the conversion. Another item to mention here, I'd mentioned that those gap years are the best time to do that between about 55 to 65. So one thing that can happen is if you turn 65, which is when you're eligible for Medicare, if you are adding too much income in those years before Medicare, one thing that can be triggered is what's called the income-related monthly adjustment amount, or IRMA for short. What IRMA is basically a surcharge that gets added on to our Medicare premiums during Medicare age. That can actually start at age 63 because the IRS actually looks at the income 2 years prior to the year that you're taking Medicare. So for instance, right now, where I say before age 64, meaning at age 63, if you have a large income, the IRS will actually look back at that age 63 when you file for Medicare at age 65 and say, this was your income during the age of 63. We're actually going to base your 65 Medicare premiums on the income that you had during your age 63. And so this could potentially be an issue if you are really doing a lot of conversions. So we do want to make sure we scale those back as you get closer to Medicare age to make sure we don't have any excess fees or premiums especially for Medicare. All right, that's just our slide again. We'll go over to the next strategy here. Again, we're still on the conversion, the point number 2, but this is just a second strategy underneath that strategy number 2. This is what we call a Roth conversion ladder. So this is going to be more common for someone who is going to be a little bit lower, or I'm sorry, a little bit earlier in their career, maybe mid-career, maybe during a lower income year, like a job change or sabbatical, something along those lines that causes your income to maybe drop for a year or two, or maybe even more. What we want to do during this year or during these combination of years is we really, again, want to look at that tax rate. We want to look at your overall income to see if there is a way that we can go ahead and we can add that income at a low rate in exchange for that tax-free growth or that 0% withdrawal rate down the road. So what that's going to entail is, again, doing that conversion and allowing us to go ahead and access that money down the road. Let me go back to this. I'll go to the next slide first, and then I'm going to come back to this last point as we cover this real quick. So this is a visual of what a Roth conversion ladder is going to really look like. So this is over a course of 3 years. So this is 3 separate conversions that we're doing, starting at the top left and then moving down to the bottom right. So again, we have 2 different buckets. We have a traditional IRA, we have a Roth IRA, and we're doing 2 things during each of those timeframes. So the first one is we're doing the conversion. So we're going ahead moving that traditional money over to the Roth IRA. And then once that conversion happens, that basically starts a clock. And that clock is a 5-year window that allows you to go ahead and withdraw any of the original conversion amount tax-free after a 5-year window. So for instance, if you converted some money in 2020 and 5 years down the road, you had an expense that came up or something that you really need some extra funds for, but maybe you don't quite have enough in your non-IRA to do that, that conversion becomes tax-free after that 5-year window has lapsed. Now, we don't advocate actively for taking money out of a tax-free vehicle if you don't have to. It's always best to leave that tax-free money in there for that long-term growth. But what you can do is you can go ahead and distribute that out of that Roth IRA. So let's say it was a $50,000 conversion, again in 2020. You want to go ahead and distribute that in 2025. Then you can do that after that 5-year window has happened or has completed there. The 5-year clock does start on January 1st of that year of that conversion. And so, again, it's going to be full 5 years before you can pull that out, but it does give you, so even if you convert on December 1st of, 2020, that counts as of January 1st of 2020, where that clock actually starts. And just to go back to this one real quick, this last bullet point here I wanted to touch on. What that is our tax withholding whenever you do pay tax on just the original conversion. So let's say you're in the 12% bracket, you pay a 12% tax. What we don't want to do is we don't want to actually withhold any of that income tax from our traditional IRA if you're under age 59 and a half. And the reason being is because regardless of your age, if you're actually taking money out of that account, whether it's for your own personal use or if it's actually to pay taxes and not for a conversion, that 10% penalty does apply. And so that is best to actually pay that tax rate if you do withhold from other money, or just to go ahead and pay that at tax time whenever you do file your 1040. All right, so covered our first 2 topics here. Now we're going to go into a particularly common topic if you are in a high income bracket, and that is going to be backdoor Roth contributions. So backdoor Roth contributions essentially allows you to go ahead and take advantage of the tax-free potential of a Roth IRA. But if you are over the income limits, which is anywhere from about 190 to about 210,000 for 2024, you can go ahead and you can still put that money into a Roth IRA, but you're doing it via a traditional IRA. And the reason being for that is under current tax law, you can still go ahead and you can put money into a traditional IRA at any income level as a non-deductible contribution. And then essentially once that happens, that's kind of that front gate, so to speak. Once you get in that front gate, really you can go ahead and you can do multiple different things with it, including converting that to a Roth IRA. So if you're not familiar with the backdoor Roth, we're happy to go into more detail on this. We're not going to cover really the ins and outs of it in this topic in this presentation, but it basically just involves going ahead and doing that, the contribution to a Roth IRA instead of one deposit into the Roth, allowing you to do it in two separate steps. So you can see here, step one is to go ahead and make that non-deductible contribution to a traditional IRA. So again, a traditional IRA, normally, if you're under the income limits, you do get a tax deduction for whatever you're putting into a traditional IRA for the current year. However, under this circumstance, you are purposely putting it in to get a non-deduct, or you're putting it in as a contribution, but you're not getting a tax deduction on that money that you're putting in there. And the reason being is because your purpose is to go ahead and convert that to a Roth IRA. So there are some different rules we have to keep track of. If someone puts money into a traditional IRA not converting it, so there are some other kind of complicated things you have to do with that if you keep the funds in the traditional IRA. However, if you just make the deposit and then convert it straight over in quick order, there's usually not a whole lot of other hoops you have to jump through. So this is a pretty easy method, even though it is two steps. So this shows the process for doing the backdoor Roth contribution. So really we're trying, our main goal is to get that money into that IRA ecosystem. So IRA, has a lot of different prefixes to it. So you have simple IRA, you have SEP IRA if you're self-employed, you have your traditional IRA, you have a Roth IRA. All those are IRAs. However, they all carry different types of tax consequences as well as purposes, depending on if you're self-employed or not. So really our main goal is to get that into that IRA ecosystem, which we can do that by putting it into the traditional IRA first. That contribution goes in non-deductible. Then we go ahead and we convert that over to a Roth IRA. So that's just a movement. It's a money movement. It's a form typically your brokerage custodian will provide to you. Your advisor can provide that to you. The easiest way to do these is in cash, as opposed to investing it right away. So, usually if you're putting that money into a traditional IRA with a purpose of converting that, you really just want to keep it in cash. It's best not to go ahead and invest that because there may be differences in terms of the conversion amount, whether that amount increases or loses. And so, there's going to be two different tax forms that are reported to the IRS once you do these. And it's usually best just to have those be about the same or within a few, dollars or cents, just to make things easier on your tax form. So let's say you put in 7,000 and then, 1, 2, 3 days later, you go ahead and move that money over to the Roth IRA. Those amounts are going to be almost identical. Once it's in that Roth IRA, we can go ahead and invest the money. We can do, whatever we want to with that in terms of getting that money to work for us. That's really the nuts and bolts of it. It's a very simple process. Again, you do want to keep track of all those tax forms, anything else that you get from your custodians, just to make sure that you have all the information you need when it comes tax time. A couple of best practices when it comes to Roth IRA, backdoor Roth contributions. One thing that is particularly something that you want to keep track of is what's called the pro rata rule. And what this looks at is the IRS does not look at your IRA per account. And so let's say you have 3 separate IRAs at 3 separate custodians, or maybe 2 traditional IRAs and maybe a SEP IRA through your employer if you're self-employed or work for someone who's a small business. the IRS kind of views all that as one lump and one bucket. So at the end of the year, whenever you do a backdoor Roth IRA, and showing the contribution and then conversion over to the Roth, IRS will actually ask for your total traditional or pre-tax IRA balance. And what they do look at with that is they will prorate any type of conversion that you make from traditional to Roth based on your total balance. And if you do have a balance in those pre-tax accounts at the end of the year, then what's going to happen is your conversion may be partially taxed based on how much you actually have in those IRAs, and as a part of how much you convert. And so the usually the best way is to have zero money in your IRA balance at the end of the year. That way you're not having to pay extra taxes, even though you're not really even realizing any income as you do the conversion. That's just, again, an IRA rule, or I'm sorry, an IRS rule, to prevent people from kind of gaming the system, so to speak. So there are some rules to keep track of there. Working with an advisor will help with that, to help you kind of understand what that looks like, because it can be a little confusing if you're just doing it on your own. If you do have multiple IRAs, it's usually best to keep deductible and non-deductible IRAs in separate accounts. So again, it's best not to have any other IRA money in those pre-tax accounts if you plan on doing a backdoor Roth contribution. However, if you do, even if you're even if you zero out those balances at the end of the year, trying to keep track of those, for taxes later on down the road, or maybe you might need to do a backdoor Roth contribution again next year. Typically, just use one IRA for just those backdoor Roth contributions. And if you ever plan on using an IRA down the future or down the road and actually getting a tax deduction on that traditional IRA, keep that as just a separate account. Try not to convert those if possible, or I'm sorry, combine those if possible. One way also to prevent yourself from getting maybe a surprise tax bill if you do run into the pro rata rule, is to use any type of retirement plans. If you work for a company that offers a 401k or 403b, you can roll those pre-tax IRAs into a 401k or 403b to combine it with that existing company plan. And since it's not in an IRA, the pro rata rule actually does not apply to 401k plans. And so you can reduce your total IRA balance to zero, even if, say, you have a very large IRA balance, but you still want to do that backdoor Roth IRA. You can do that by rolling that IRA into the 401k or 403b, or even a TSP if you're a government employee too. So there are some ways to go ahead and kind of work around that pro rata rule if you do have a large IRA balance. All right, we covered the first three topics here. I'm just going to check and see if we have any questions offhand so far. All right, I don't see any right now. So we'll keep moving forward at the moment and cover a couple other topics before we start opening it up for other questions. So strategy number 4 is our tax-free basis withdrawal option with a Roth IRA. So tax-free basis withdrawals really involve that ability to use your Roth IRA as a secondary source of short-term funds, really for an emergency situation, something that you kind of have exhausted several options for. Maybe that you have some other options to pull the funds out of, but they might create excess charges, things like that. So this is really a temporary or short-term thing, but it's still a very good option if you do ever need it or run into it. So what is a basis withdrawal? So basis withdrawals means that when it comes to depositing money into your Roth IRA, again, all that money that goes into a Roth IRA is post-tax money. So you've already paid tax on that money that goes in, and again, exchange for that money to come out tax-free. So because you've already paid the tax on that money, that actually can be withdrawn at any point, tax-free, out of that Roth IRA up to the amount that you deposited. So, case in point would be, let's say you put in $5,000 into your Roth IRA last year, have a HVAC repair, car repair, and maybe your son or daughter going to college at the same time. Just everything adds up together. Need a little bit of short-term funds. That $5,000 you can go ahead and withdraw at any point. So even if you've made money on it, if you just take out what you put in, that washes out, and you can go ahead and take that out. Um, the main point on this, I think, is to go ahead and then use any other funds that you have first. If you do have an emergency fund, which we do recommend keeping at least 3 to 6 months of expenses in your savings in a non-IRA that's available liquid. Really taking that money out first. That's not in any type of retirement account. If you have it in just a cash, checking savings account, bank account, all that money is going to just be in there and able to be withdrawn. Easiest to take that out for an expense. However, if you do need to take it out, a couple things that it really, I think, are used best for. So let's say that expense is less than 7,000 if you're under 50, or maybe right around 7,000 or 8,000 if you're over 50. Because you have that contribution limit of 7,000 or 8,000 if you're over 50, you can basically just use that money and swap it out as soon as you cover your expense. So that's just a really easy way to match up those expenses with that contribution limit that allows you to go ahead and put that money in. A lot of people think, once once I put that money in that Roth IRA, it's locked up. You can't touch it at all, and that's not the case. There is some good reasons for being able to take that out, but we just want to be mindful. If it has to be more than the annual contribution, that's fine. You can carry that over to another year. It's just that you are kind of delaying a little bit more with that growth of that asset if you take out more than what you can kind of redeposit. Paying for the expense, if you have to pay for the expense, through other methods, and that's going to, create a, pretty large, expense or tax and fees. Say for instance, a credit card that's going to be charging you double-digit interest, or, maybe any other type of loan right now, since we have high interest rates. There can be a lot of good reasons for going ahead and just taking that short term from your Roth IRA instead of paying those penalties or interest from from another bank card or credit card or something like that. So again, another good reason to take that out is if you have exhausted all your options and the only one out there is going to charge you extra, excess penalties, fees, or taxes. This is really one of those good reasons to take it out. So just a point of education here at the bottom. The reason that we're able to take that out is based on the withdrawal ordering rules that govern how Roth IRA withdrawals are treated. And so there's really three main components of a Roth IRA, the balance in that. The first one is contributions, the second one is conversions, and then the third one is earnings. And so what the IRS dictates is that when you do go to withdraw funds from a Roth IRA, it doesn't have to be from that particular account, or maybe a rollover from a Roth 401k, or maybe a common, if you combined a Roth IRA with another one, some point in the future, any of those contributions that you've made over the lifetime of making those contributions to your Roth IRA, those contributions come out first. And again, because you paid taxes on those first, those can be withdrawn tax-free as the first order. So once you've taken out, say, all of those contributions, then the next in line we go to the conversions. And so as we talked about before, conversions are able to be withdrawn tax-free after 5 years. So as long as you've had that Roth IRA open for a good chunk of time, if you've passed that 5-year mark, even if you've exhausted all the contributions, you can take out the amount of your contributions tax-free if you've reached that 5-year window. And then third, we have our earnings. So earnings are, again, what the growth has made on those investments. If you've invested the money into your Roth IRA, now you're earning money on that. So earnings are not able to be withdrawn tax-free until you've actually reached age 59 and a half. So those are a longer time frame than the first two. Again, if you have reached age 59 and a half, then really the contribution and the conversion rules really aren't important, because anything can be taken out of your Roth IRA at age 59 and a half, as long as you've had it for 5 years. So there are a separate 5-year window for qualified withdrawals versus just those conversion windows. So again, those 5-year windows are two different windows. But if you've had the Roth IRA and you've made a deposit into it 5 years before you take it out and you are age 59 and a half, then anything can be taken out of the Roth tax-free. All right, coming up on the end here. So the last thing that we're going to talk about today is the ability to um, withdraw or you really pass down this tax-free money that we've worked hard for. So, whether you are charitably inclined, whether you want to pass money on to just your own family, regardless of your intentions, Roth IRAs can become just a great source of leaving your own legacy, making sure that you are remembered in the way that you want to be remembered, and really set your heirs up for the best possible future that they would have if you are inclined to give something, whether you pass away or if you actually want to do something during life as well. Uh, so we'll cover our last point here, and then as we finish this up, we'll go into any questions we have on these. So the first one is you're really just because of the tax-free status that Roth IRAs hold, they really make one of the best gifts post-death. And the great thing about a Roth IRA is that the IRS has actually not declared that a Roth IRA is taxable when it gets passed down to an heir. So, regardless if you are, very well advanced in years and your heir is very young, it doesn't matter about age. Anytime you pass down a Roth IRA, that retains its tax-free status. So if say you're the person inheriting the Roth IRA is well below age 59 and a half, they can still go ahead and use that money tax-free and pull that out, even including the earnings if they are if they are within that Roth. And so that's a great way to go ahead and just kind of give an extra benefit if you haven't used those during your lifetime and you want to really give the best gift possible. That tax-free gift allows them to kind of compound and even make that gift go farther because of the tax-free nature of it. So one thing about giving money to any heirs when you do pass away is that there is now a 10-year window that a inherited Roth IRA must be taken out. So even though Roth IRAs don't carry any required minimum distributions during life, they do carry required minimum distributions for those who inherit them. So again, the terminology on that is going to be inherited Roth IRA or maybe a beneficiary Roth IRA. Those two terms are synonymous when it comes to that that IRA that's been passed down to you. So the nice thing about that is that you do still have 10 years to make that grow. And so because of the fact that there's no required minimum distributions until you reach age or year 10, that money can still continue to compound, can still continue to grow. You obviously can take that out before that 10-year window, but you can really treat that kind of like your own Roth IRA, just with a little bit shorter time frame. So there's still a lot of great potential for that, even though there is that window that kind of comes into play with that 10-year mark. So one strategy we did want to kind of highlight here. This may not apply. It's a fairly specific strategy, but that does still allow you to kind of extend that 10-year window out a little bit more if you are before age 59 and a half, or say you have a long time frame yet before you might be withdrawing that money. If you are the beneficiary of a Roth IRA and you don't currently have your own Roth IRA, maybe maybe you are just contributing to your company plan, your 401k, your Roth 401k at work, but you're not really doing anything above and beyond that. You may consider going ahead and kind of doing a swap from that inherited Roth IRA over to your personal Roth IRA. You do have to make sure that you're under the income limits to do this. So there's a few stipulations, but really what the goal would be here is to extend that 10-year window. So taking out, let's say you have a $50,000 balance of the inherited Roth IRA, and you have to take that out within that 10-year window. Going ahead and taking out, let's say 7,000 or 8,000 of that Roth IRA, I'm sorry, from the inherited Roth IRA, and then using that as a contribution, not a conversion, but a contribution into your personal Roth IRA, that lets you take advantage of that window, that freebie that the IRS allows you to put into that personal Roth IRA. That counts as that current year contribution. However, once you get that into your personal Roth IRA, you are taking that out of that inherited, which means that you're not subject to that 10-year rule under your personal Roth IRA. So we're effectively extending that growth time frame of the funds for more than that inherited time frame, that inherited Roth IRA time frame window that we normally subject to. So that goal is really, again, to extend that window. If you are pretty close to age 59 and a half, this wouldn't really apply because anything that's in that Roth IRA is going to be tax-free regardless. However, if you're less than 10 years before turning age 59 and a half, you probably wouldn't want to do it because of the fact I'm sorry, if you don't plan on taking the funds out in the next 10 years, then you want to do this strategy. The reason being is because if you have an inherited Roth IRA, all the money in that account is tax free. So let's say you're only 40 years old and you have plans to go ahead and take that out, in the next 5 years. You want to go ahead and leave that in the inherited Roth IRA because that will allow you to get those earnings as well out tax free. However, if you're less than 10 years before turning age 59 and a half, and you're going to be getting into that window to where you will be able to withdraw those funds tax free, including the earnings, then it makes sense to go ahead and put that money into your own Roth to be able to extend that window out a little bit more. So hopefully this is somewhat clear. Again, it's more of an advanced and kind of a specific strategy, but we did just want to highlight that as a way to potentially extend that time frame on that inherited IRA money. All right. And with that, we're going to go ahead and finish up the regular slides. And so right now we'll go ahead and open it up for questions. All right. So first question that came in here is, how much can I put in my spouse's Roth IRA if they aren't working? So great question. So spousal IRAs, traditional IRAs, Roth IRAs, they're the same amount that you can put into your own personal Roth IRA or traditional IRA if you are working, which is $7,000 a year if you're under 50 and $8,000 a year if you're over 50. So same contribution amounts. You do want to make sure that you're not over contributing. That $7,000 limit applies to any traditional or Roth IRAs in total. So if you put in 3,500 into a Roth, you can only put 3,500 into the traditional. Or if you already put in, let's say, 2,000 into your traditional and you're under 50, you can only put 5,000 into the Roth to up to that $7,000 or $8,000 maximum. Next question is, at what income should I contribute to a traditional IRA versus a Roth? So right now, under current tax rules, the bottom two tax brackets are 12% and 10%. So those two tax brackets historically are a very low rate across all of our tax code to pay income or to pay tax on earned income. So anytime you're getting into those 10%, 12% brackets, paying that tax now is usually one of the best tax times you're going to have for that. Rarely are we going to see a tax rate that's going to be lower than that, especially if we continue to see inflation being an issue right now. The IRS is not going to want to lower that rate a ton because of the revenue that it's receiving. So anytime we can lock in that rate as we have it, it's usually a good time to do that. If you're a high income earner and that that tax bracket is bumping up into the 22 or the 24% realms, those brackets are more of a normal type of a tax bracket that we're seeing right now. 22% is still a fairly low rate. So I would say if you're there, still a Roth is going to be still a good choice. It depends on what your income is going to be projected to look like. We run projections to determine, where you're at in terms of, your potential income tax that you might pay. If you're going to be paying, 30% down the road or 32%, a 20%, 22% tax rate is actually pretty favorable. However, if you think you might be retiring in the next year or two and, paying more of a 12% rate in the next couple of years, it might make sense to defer those taxes and put that money into a traditional IRA to get that deduction now, if you're going to be in a higher bracket than you might be in the future. Let's see here. What is the difference in taxes between taking money out of an IRA versus a non-IRA? So a non-IRA is going to be something that does not have a a taxation component whenever you pull it out. So something like a non-IRA might be a trust or a joint or individual account. That's again just think of it kind of the same status as like a checking account at your bank. It's not attached to a retirement account, so to speak. So any type of non-retirement account, the capital gains tax rules apply. So capital gains are going to be on anything that has gone up in value. So we're going to attach um, a basis to that, meaning that you have a starting point. So let's say you bought something for $1,000 and now it's grown over time and it's worth $2,000 now. That gain on that is 1,000 because you started with one, now it's worth two. So the difference between that is $1,000. So you would take that $1,000 that would be counted as what's called income or capital gains income, and that capital gains income would be taxed at the capital gains rates. Currently, capital gains are taxed at 0%. If you're under a certain threshold, it's about 40 to 45,000 if you're single. If it's about 80 to 80, actually about 85 to 90,000 if you're married, to where that's actually a 0% rate. The government actually does prefer capital gains. It's actually a good thing for our economic environment. And so it actually attaches a lower payment, a lower tax schedule to capital gains for those. That does apply to long-term capital gains. If it's a short-term capital gain, that's going to be something that's less than a year. That's going to be taxed at normal income rates. And so just as the same as if you're taking money out of a traditional IRA or even working, those tax rates are going to be taxed the same because that's active or current income. If you are taking money out of a traditional IRA versus a non-IRA, that counts as normal income. And so it's just the same thing as if you're working. Those are going to be taxed the same. You just put them in the tax table, and that will determine how much the rate is that you pay. All right, looks like we have another one here. So this one is, can I put money in my 401k as well as my IRA? And the answer is yes, as long as you are under the income thresholds. So 401k is a government, or I'm sorry, not a government, an employer plan. And so there are no income limits on 401ks in terms of how much you can deposit into those. So as long as your salary meets the annual limits, of the amount that you contribute, it's north of 25,000 that you can put into a 401k. That is okay. That's totally fine. And then if you're under the IRS limits for putting money into a traditional or Roth IRA, you can also do that in conjunction with your company plan. So right now we do have, let's see here, the single, the limit for putting money into a Roth IRA, if you're single, in terms of your income, if you make less than $146,000 a year, you can go ahead and put money into a Roth IRA if you're single. If you are married and you make less than $230,000 a year, you can put that money into a Roth IRA as well. And then there are some other limits to put that money into a traditional IRA if you're single or married as well. All right, just checking again here to see if there's any other questions. Looks like that's all the questions we have for now. If there is anything else that comes up, we'd love to get in touch and just have a conversation with you. If there's anything that you'd like to discuss, if you have not yet set up a Roth IRA or are considering retirement, don't know what options you have with your retirement funds. If you've never actually worked with a financial planner before, we are a fee-only fiduciary financial planning and investment management firm. So we do specialize in working with Christian outdoor enthusiasts and their families. And if you don't fall in that realm, we also still work with other people outside of that. But we'd love to have a conversation with you and determine if there's anything we can do to help out your situation. We're located in Billings, Montana, but we serve the whole country as well. So feel free to scan the QR code, and that'll get you to our Contact Us page. We'd love to have a conversation and see what is on your mind and if we can add value in any way.